What if I told you the fastest stock market recovery in history is just a misunderstanding? You've probably seen headlines like this one. Doesn't it seem off that the stock market is blazing past record highs while the economy is in freefall? And at the same time a record 50 million Americans are sitting around without a job? It should. Because all the fuss about the stock market's comeback comes down to a misinterpreted term. As I'll show, what all these headlines refer to is no longer the stock market as we know it. Most stocks have a long way to full recovery. And this confusion puts a lot of investors at risk without their even realizing it. What is the stock market, after all? When you hear words like the stock market or stocks in the media, they are not referring to every single stock in America. They are usually referring to the S&P 500, SPX. The S&P 500 is an index that tracks the performance of America's 500 biggest companies. The index contains 75% of all American stocks and is considered the key gauge of the overall market. This term is so prevalent it has become a synonym for the entire stock market. That's why people mindlessly throw it around when they talk about stocks. So let's take a quick look at how the index arrives at the figure you see in the headlines. In short, the index calculates the total performance of all the 505 stocks it includes. But it's not as simple as adding up the growth percentages and dividing by 505. Each stock in the index carries a weight based on its company's size, known as market cap. The heavier the stock, the more its performance affects the index. For example, Apple AAPL, with its market cap of $1.7 trillion, has a 5.3x higher impact on the index performance than does Visa with its $0.325 trillion. This formula is supposed to give us an accurate picture of how America's entire stock market is doing. Problem is, it doesn't work today. The S&P 500 no longer represents the stock market. The 505 stocks in the index come from a range of sectors that used to have a proportionate weight in the index. From 2001 to 2019, the breakdown by sector looked more or less like this, but that's no longer the case. During the pandemic, investors flocked to tech in droves and tech stocks hijacked the S&P 500 big time. As you can see below, today they make up over than 27.5% of the benchmark index. But if you add in Google, Amazon AMZN, and Netflix NFLX, stocks that aren't labeled as tech stocks in the S&P, the tech's share in the index swells to a staggering 36.6%. That's the highest share of tech stocks in the S&P 500 ever. Even in 2000 during the dot-com craze, tech stocks didn't dominate the S&P 500 as they do right now. Tech was a ballistic force driving the entire S&P 500 this year. The S&P 500 soared 50% from its lows, blazing past its record before COVID. That has given investors the wrong impression that the entire stock market is booming.